so much for joining again. Today I would like to give you a comprehensive overview of activity ratios used for financial analysis and evaluation. We discussed ratios already when we were looking at income statements, balance sheet, and cash flow statements, and we really looked at those financial statements and discussed which kind of key ratios can we extract from those financial reports. However, this time I would like to do it the other way around to look at, okay, which different categories do we have and which kind of ratios do we need to get an understanding about a company's activity, profitability, solvency, and liquidity. So we start with activity here today, and then you see 3 additional videos, one for profitability ratios, one for solvency ratios, and one for liquidity ratios. And then I think with those 4 videos, you have a full set of ratios needed. First one, before I get started, ratios and some of the abbreviations sometimes are used interchangeably, sometimes are used with slight changes. So really think about what is it that you want to measure, what is the ratio, and sometimes it is used somewhere else just with a different term. So I try here to not overcomplicate, but give you a few nuances what may be different if you compare one wording with a different wording. So let's start with activity ratios. They're called activity ratios because they measure the operating efficiency of a company. Sometimes they are also called asset utilization ratios. So how good you're using your assets in the company to generate sales, for example. It measures the operational performance. And basically, if you look at the asset side, it tells you how effectively a company is using their working capital and their long-term assets. Yeah, there are a few key ratios. Let's go through step by step. So the first one is called inventory turnover. And the formula is cost of goods sold or cost of sales divided by average inventory. Here again, inventory is a balance sheet item, so we usually take the average, ending minus beginning divided by 2. There are a few nuances where it may be better to take the ending balance sheet number, but I will come to this when we are talking about a few other ratios. The next one is days of inventory on hand, also called days inventory outstanding, DIO. And the formula is number of days in a period. So it really depends on what is the period you're looking for. If you take average inventory, for example, and you look at beginning of the year, ending year average divided by 2, then you're looking at 1 year. So your period should also reflect your denominator. So what it means is here, number of days in period, if you look at 1 year, 365, and then in the denominator, you have your inventory turnover, which is the formula above. If you use this formula here and plug it in here, then you basically get average inventory divided by cost of sales or cost of goods sold times 365. Sometimes it is used a bit differently. Some analysts say days inventory outstanding measures how many days it takes for a company to sell its inventory. A lower DIO indicates faster inventory turnover, and a higher DIO may suggest slow-moving inventory or inefficiency. Whereas DOH, days on hand, days inventory on hand, measures how many days a company can operate with its current inventory level before running out. Sometimes it's calculated a bit differently. It is sometimes calculated at ending inventory divided by daily cost of goods sold. And if you look what is daily cost of goods sold, daily cost of goods sold equals 65, then you put this in here, and basically what happens, you get this formula out. The only difference is that you have taken an ending inventory number and not an average inventory number. So I think the approach, the formula is the same. Some say this one is more a historical approach, and DOI, not DOH, is actually using average inventory and is more forward looking. Yeah, but in the end, it basically explains you the resources tied up in inventory. Yeah, can be used to indicate inventory management effectiveness. Both of them, inventory turnover and inventory days of inventory on hand. Again, high inventory turnover ratio relative to industry norms may indicate highly effective inventory management. However, a high number could also indicate that the company does not carry enough inventory. Yeah, so whenever you use those ratios, just be mindful, what does it mean? Is high or low always good or not? Because as with any ratio, it tells you what the ratio is, but it doesn't tell you why. Yeah, so always look into it. Next one, we talk about receivables turnover and days of sales outstanding, DSO. Receivables turnover revenue divided by accounts receivables or trade receivables. It would be more appropriate to actually use not revenue but the sales. If I say revenue, we can also replace for sales. So it would actually be more adequate to use not revenue, not total revenue, but the revenue or the sales made on credit, because this is what we are measuring against. However, this information is not easily available, so we usually go for revenue or sales and then average account receivables. And this receivable turnover and also days of sales outstanding, the difference here between receivables turnover and days outstanding is that this number, because we multiply with days in a period, gives you a day number, whereas receivable turnover gives you a ratio, 1 times, 2 times, 3 times, and gives you a magnitude. Same for inventory turnover, it gives you a magnitude, whereas days, DOH or DSO, will give you a day figure and give you a timing figure rather than a magnitude figure. Yeah, so both reflect how fast the company collects cash from customers to whom it offers credit. Yeah, receivable turnover and DSO. And then the last pair, they also go together, which is payables turnover and number of days of payables. I prefer days of payables outstanding, DPO, because then we have DIO, DSO, and DPO. It's a bit easier to remember. It's exactly the same. Cost of goods sold, average accounts payables or payables, and then here we get a magnitude, we really get a ratio, whereas here number 6, a number of days in period, many times 365 divided by this formula. So if we plug this in here, we basically get average accounts payable or payables divided by cost of sales or sales times 365 most of the time. And this really reflects the average number of days. When we look at this average number of days the company takes to pay its suppliers. And the payables turnover ratio measures how many times per year the company theoretically pays off all its creditors. Yeah, so again, gives you a magnitude, gives you a timing. Very important here, and you see some of the formulas in the internet not really correct. Receivables turnover, accounts receivables, they get created when you sell something, when you sell to your customers. So accounts receivable needs to be matched with revenue. Whereas inventory and accounts payable is the incoming side. Cost of goods sold or is basically recognized when something happens with your inventory. Yeah. So what does it mean? Average AP, accounts payable, is supplier side, refers to inventory. So when you sell the product later, it belongs to your cost of goods sold. Same with your inventory. It comes from the supplier side. When you sell it, your cost of sales or cost of goods sold gets recognized on the income statement. Yeah. So accounts receivables or receivables belong to revenue, inventory, and payables belong to cost of goods sold. That's why we use the different formulas. 3, we had another video on those. Basically, number 2, number 4, and number 6 is basically your cash conversion cycle. I made another video on this, which is cash conversion cycle, DSO plus DIO minus DPO. That's how you do your cash conversion cycle, just to close the loop. And then we have 3 other formulas. One is working capital turnover, revenue divided by average working capital, how efficiently the company generates revenue with its working capital. If you have a working capital turnover ratio of 4, for example, it indicates that the company generates $4 of revenue for every dollar of working capital. Yeah, so again, I explained this in another video. Input, output. So how much do you generate from your working capital? Same here, fixed asset turnover. Fixed means long term. Again, how much average net fixed asset generate, how much revenue, and then the same applies for total asset turnover. Average total asset, how much goes in, how much comes out. And basically these are the key activity ratio formulas. Thank you so much for listening. I see you in another video. Bye bye.